Welcome to vTalkInsight, Allocator's Lens Daily for December 3, 2025. Cross-asset markets are entering the week with a striking tension between AI-driven optimism and mounting concerns about leverage, liquidity, and a Federal Reserve that is now almost fully priced for near-term rate cuts. With equities near recent highs, bonds flashing slowdown signals, and crypto firmly risk-off, the key question for allocators is which asset class is telling the truer story about the next leg for risk. In equities, the headline remains upbeat, but the foundations look more fragile the closer you get. Major United States indices have been grinding higher, with the S&P 500 not far from recent peaks and gains once again led by big technology and the so-called Magnificent Seven. Underpinning that strength is a broad-based improvement in earnings revisions, with many strategists now looking for healthier profit growth and a more inclusive rally stretching into 2026. AI is at the center of that story, as hyperscalers like Amazon Web Services, NVIDIA, and others signal surging demand for compute, data centers, and custom chips, while software names such as MongoDB report powerful AI-related upside that has lifted the wider enterprise tech complex. Importantly, leadership is no longer entirely confined to mega-cap AI enablers. We are seeing signs of rotation and broadening, from consumer and travel stocks benefiting from stronger than expected holiday metrics and robust demand for events like Travel Deal Tuesday, through to select industrials such as Boeing that have rallied on improving cash flow outlooks. Smaller cap benchmarks and the Russell 2000 have shown periods of outperformance versus the largest tech names, and pockets of old economy retail are beating expectations where product innovation and newness are resonating with shoppers. Deal activity reinforces that risk-on tone, with the United States merger and acquisition pipeline tracking toward near-record volumes and high-profile media and streaming transactions on the table, while policy proposals like the Invest America Act point to structural, long-dated equity inflows via government-funded investment accounts for newborns. Set against that, the list of equity risks is getting longer, not shorter. Concerns are mounting that parts of the AI complex already embed extremely ambitious capital expenditure and revenue assumptions, with estimates of $5 to $7 trillion of AI infrastructure spend over the next 5 to 7 years and talk of $1 trillion in cumulative AI capex by the end of the decade. Regulators like the Bank of England are launching new stress tests aimed squarely at private markets and AI-exposed assets, while market participants flag circular financing between venture capital, corporates, and AI startups that could amplify any downturn. Tech volatility is elevated, margin loan balances are growing at more than 30% year-on-year, and we are seeing sharp single-stock reversals, from cybersecurity firms missing expectations to fintech names like Block selling off on softer growth guidance. Beneath the surface, risk appetite looks more cautious than index levels suggest. Record money market fund balances around $8 trillion, institutional investors staying largely neutral, and a visible shift toward index and ETF options for hedging all signal a desire to protect rather than extend risk. The roughly 30% drawdown in Bitcoin since October, accompanied by spot ETF outflows and limited dip buying, also points to froth being drained from speculative corners that had been key drivers of the equity story earlier this year. At the same time, equities are effectively pricing a benign mix of strong earnings growth and substantial Fed easing, while bond markets are much more focused on slower growth and policy uncertainty, a combination that is unlikely to be fully realized. Heading into the upcoming Fed meeting, payrolls, and inflation releases, the big equity question for allocators is whether the AI and consumer strength narrative can withstand any disappointment on the pace or scale of rate cuts. Turning to rates, markets have moved from hoping for easier policy to effectively demanding it. Fed funds futures now assign something close to a 95% probability of a near-term rate cut, with additional easing penciled in over the coming year, even though hard macro data have not dramatically weakened in recent weeks. Some officials are increasingly focused on emerging softness in the labor market and the risk of growth undershooting consensus in the next quarter, reinforcing the dovish narrative. Yet other voices emphasize that inflation has not established a clear downward trend, and that hiking again in 2026 or 2027 cannot be ruled out if cyclical and structural price pressures re-emerge. Rate moves themselves have been choppy and at times counterintuitive. Despite weak manufacturing data, including 9 consecutive months of contraction in ISM indicators. United States 10-year yields have pushed higher following recent sell-offs, while shorter maturities have edged lower, hinting at a tentative steepening of the curve. Part of that reflects supply concerns, with the prospect of a legal ruling that could force tariff refunds and increase Treasury issuance, putting more pressure on the long end. Thin year-end liquidity is also amplifying swings, and some analysts see the latest global bond sell-off as more a function of positioning than a clean macro signal. Against this backdrop, many allocators see renewed value in high-quality fixed income. Nominal and real yields are now at levels that can potentially buffer portfolios if richly valued risk assets correct on a recalibration of Fed expectations. Some multi-asset portfolios have already extended duration towards 6.5 years to build in more downside growth protection, while still holding targeted inflation hedges through commodities such as gold. Demand for safe havens remains evident outside the United States as well, with a recent Japanese government bond auction drawing strong interest in helping to stabilize 10-year JGB yields after a bout of volatility. The core tension for rates is that markets are almost fully priced for a near-term policy pivot at a moment when the Fed itself appears divided and inflation risks have not fully faded. If the central bank delivers fewer or later cuts than the curve implies, yields, particularly at the front end, may need to reprice higher, with knock-on effects for equities, credit, and the dollar. Conversely, if growth data deteriorate more sharply, the long end could rally even as issuance needs rise, complicating curve dynamics. For now, upcoming jobs data, inflation prints, and the Fed meeting are likely to dominate rate volatility, and how those events resolve will go a long way toward determining whether today's cross-asset optimism or the bond market's caution proves closer to reality. In credit, surface-level indicators still paint a benign picture, but there are growing signs of underlying strain and dispersion. Risk premiums on United States corporate bonds have corrected from earlier extremes, with spreads converging toward those in other regions and chipping away at the long-standing United States exceptionalism narrative. Default rates in high-yield and loan markets hover in the mid-2 to 3% range, suggesting no imminent broad-based distressed cycle, and base rates around 3 to 4% offer decent carry for many issuers. At the same time, markets are clearly differentiating more aggressively between winners and losers, and that is likely to intensify into next year. A major driver of future credit supply is the AI infrastructure wave. Forecasts of $5 to $7 trillion of data center and related investment over 5 to 7 years imply significant funding needs, and investment-grade markets are expected to see technology giants such as Meta, Amazon, and Microsoft emerge as top issuers as their capital requirements grow. On the positive side, these hyperscalers bring exceptionally strong balance sheets and free cash flow, which may limit credit risk for long-duration investors. However, a sizable portion of AI-related spending is also being financed through opaque private credit structures, and there are growing concerns that aggressive, often debt-funded capex may not always deliver the returns underwritten, echoing past episodes of sector overinvestment. Beyond AI, several flashing indicators highlight broader credit vulnerability. Margin debt has been growing at a pace faster than during the 2020 zero-rate period, raising the risk of forced liquidations in a downturn. Digital asset treasury companies, such as those that have borrowed against large Bitcoin holdings, act as volatility multipliers, with worries that equity drawdowns or further crypto declines could prompt selling that feeds back into both bond and equity markets, even if current collateral values appear ample unless Bitcoin falls dramatically. SoftBank's share price weakness and rising credit default swap activity underscore how quickly sentiment can turn on leveraged AI plays. Looking ahead, allocators are likely to pay close attention to private credit transparency, refinancing risks in sectors exposed to AI disruption, and any widening in spreads that might signal the benign default backdrop is starting to change. Foreign exchange markets are quietly reshaping the global return landscape. The long-running appreciation trend for the United States dollar has stalled, and many strategists now expect a multi-year period of gradual depreciation as the Fed and the Bank of England retain more room to cut rates than other G7 central banks. On a trade-weighted basis, the dollar is seen as overvalued, and prospective easing in the United States is likely to exert downward pressure, particularly versus Asian and emerging market currencies. Several emerging market central banks have already built up high real interest rates and may soon be able to ease policy without triggering destabilizing currency moves, potentially shifting the geography of global risk-taking over the next cycle. Safe haven dynamics are also important in this mix. Strong demand at a recent 10-year Japanese government bond auction helped stabilize yields after a period of turbulence, providing some support to the yen and underscoring continued global appetite for high-quality sovereign assets amid equity and bond volatility elsewhere. More broadly, expectations of a softer dollar and relative policy caution in Europe and Japan fit with the idea that the extreme concentration of flows into United States assets over the past decade may slowly begin to unwind. For currency-sensitive strategies, these shifts in policy divergence and safe haven preferences are likely to loom large over the medium term. The most dramatic currency moves, however, remain in digital assets. Bitcoin's near 30% slide since October, $1 billion in liquidated leveraged positions, and persistent outflows from spot exchange-traded funds all point to a marked reduction in risk appetite and tightening liquidity. Large incremental buyers such as MicroStrategy have stepped back, and digital asset treasury companies now act as volatility amplifiers, with concerns that equity drawdowns could force them to sell underlying coins, reinforcing downside moves. Yet the structural backdrop is not one way. Regulatory efforts, including innovation exemptions for crypto, mainstream platforms allowing more exchange-traded funds, major banks recommending small digital asset exposures for selected clients, and declining hacks and fraud, all suggest institutional trust is improving. Crypto price action seems increasingly driven by macro factors such as Fed policy and global risk sentiment, making it a high beta barometer of broader appetite for speculative risk. Commodities add another layer to the cross-asset picture, especially around inflation and real assets. Oil prices themselves remain range-bound despite persistent geopolitical tensions, as expectations of ample supply and the rebuilding of the United States Strategic Petroleum Reserve help cap near-term upside. Markets have largely shrugged off regional conflicts unless they directly threaten energy flows, but technical analysis suggests the energy equity sector could be at a turning point after a long period of sideways trading. That makes the relationship between spot oil, energy stocks, and broader inflation expectations a key area to monitor. Industrial and strategic metals tell a somewhat tighter story. Competition for key raw materials between Europe and the United States is intensifying, with the European Union committing billions of euros to reduce reliance on Chinese supply for critical technologies and defense applications. Germany's plans for almost €3 billion in new defense procurement, and a broader shift toward AI-enabled military systems, are likely to keep demand firm for certain metals and components even if global growth moderates. This adds a structural element to commodity demand that goes beyond short-term macro cycles. The AI build-out also has direct implications for commodities. Rapid expansion of data centers and high-performance chips is straining supply chains for power, specialized materials, and infrastructure, creating localized inflation in the physical inputs needed for the digital economy. At the same time, many expect AI to be disinflationary over the longer run by boosting productivity, highlighting a potential mismatch between sector-specific price pressure now and macro-level effects later. Some diversified portfolios have responded by pairing longer-duration bonds with selective commodity exposure, including gold, as a hedge against scenarios where material and energy costs stay elevated even as growth cools. How these real asset dynamics evolve will feed back into both inflation expectations and the cost of capital across other asset classes. Across assets, the message today is one of optimism built on increasingly narrow foundations. Equities are leaning hard on AI growth, resilient consumer demand, and expectations of swift Fed easing, even as leverage builds and speculative pockets like crypto are already in the process of de-risking. Rate markets, for their part, have largely pre-priced a dovish pivot yet continue to flash warnings through higher long-end yields, choppy liquidity, and a disconnect between weak manufacturing data and bond behavior. Credit still looks orderly on the surface, but private markets, AI capex funding, and margin finance point to rising dispersion and a heavier tail of idiosyncratic risk. Meanwhile, a softer dollar trend, a reset in digital asset valuations, and a commodity complex that mixes calm oil with tighter metals and energy constraints all reinforce how important policy, supply chains, and real-world capacity will be for the next phase of the cycle. For allocators, the critical watch points from here are the upcoming Fed decision and data, the evolution of AI-related investment and financing, and any signs that today's narrow areas of stress are broadening into the core of equity and credit markets. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.